So we're going to talk about business credit, how to prepare for getting a loan, how to prepare your finances basically, what kind of lenders you can look for, how loan applicants such as us may be evaluated, the difference between a business credit card and a personal credit card. We'll talk about business loans, letters of credit, business leasing, account receivable financing, and inventory financing. So, what is business credit? Business credit is a way to get somebody else to lend you money to operate your business, and you, as the business owner, promise to repay it at a later point in time. Business credit is like personal credit. It's always good to establish it, and it's even better to maintain it with a good credit history. When you have business credit, or when you get business credit, then you become creditable to other people, companies, banks, other lenders, any vendors that you have. Anybody looking at you for whatever reason may examine your business credit to determine your credit worthiness. It's almost like a report card of how you're doing. So remember, once vendors or lenders extend you credit, it's critical that you don't forget to pay. It's critical, just like personally, that you pay on time. And that payment report of you paying vendors on time is one of the best ways to improve your credit history and to show your credit worthiness. Always important. It's just like personal credit. So, how do you prepare for getting your first loan or getting another loan or a line of credit? How do you prepare? And this is true for whether you're starting out or you're going after more, which hopefully you'll do as your business grows. Well, to prepare for getting business credit, you need to look at what you have right now. So obtain and review your personal and business credit reports. Most importantly, if there are errors on it, correct them immediately. You all know the 3 credit reporting agencies. Check all 3. And you can get a copy of your credit report from all 3 reporting agencies at no charge once a year per individual, and there's the website. Now, I don't know about you, but my bank will provide me once a month with my FICO score. And as a matter of fact, I went on this morning and checked it just to make sure everything was okay. And it was. I can check it on a monthly basis. So you might talk to your bank and see if you can get, if you have your personal accounts there as well, see if you can get a copy of your FICO scores. And if you are having problems, the bank can help you clean up your credit. But I can't enforce to you how important your personal credit is towards establishing good business credit if you're a small business and you're the owner. Whether you're a corporation, an S Corp, a C Corp, an LLC, a sole proprietor, no matter what, your business is tied to you. In addition, you may have to have a business license and a permit depending on your city and state. In California, you may be required to have certain business licenses and permits and to show that you are in fact an established business. If you're in the city of Los Angeles, if your business is within the city of Los Angeles, I will tell you that it's important to have a city business license. So you might want to check that out for the city where your business exists. One of the most important things you can do is open a business checking account. And that is a good step in separating your personal credit from your business credit profile. If you have a good relationship at the bank where you have your personal accounts, you can talk to them about opening a business account and how to keep the credit profiles separate. But again, please be aware that if you're a small business and you are the owner, however it's structured, your personal credit will affect your business credit. Your business credit won't necessarily affect your personal credit, but they are tied together. See if you can find minimum balance requirements and lower transaction costs when you look at a business checking account. I know for SafeWork we get a lot of perks in our business accounts that individuals don't get in their personal accounts. So keep in mind that. Again, once you've established a credit rating for your business, you monitor it for accuracy and you take care of any errors or discrepancies instantly. In any of your business or personal accounts, the recommendation is, from me personally, that you stay current on everything. No late payments, no collections, no tax liens, if you're going to approach a lender. And you may be asking me, well, why is that? Why do you have to stay current? Or what if I've had problems? Because the lender will look at your personal credit history as well. That's right. When you go asking for money, when you go to ask if someone will lend you money, they want to know all about you. Just like if you get certified as a small business or a disadvantaged business, they want to know everything about you. And in this regard, they will go through your personal financial underwear drawer. Make sure your personal financial underwear drawer is organized and clean. If you have had some blips in your personal credit, take a very aggressive stance at cleaning it up. I repeat, take a very, very aggressive stance at cleaning it up. And if you need help, go to your bank and ask, can they provide that assistance? Most banks will help you work on cleaning up your credit. It's in their best interest. So, what are you going to need to provide if you're going for a loan? Tax returns. A lender will ask for 1 to 3 years of personal and, if applicable, business federal tax returns. They use these as whether or not you have a strong historical financial history, what your assets are, what the liabilities are, and the profitability of both your business and you. Now, you may say, but my business hasn't been in business for a year yet. I don't have a business federal tax return. The good news is you will. The bad news is if you don't have a business federal tax return, they will look at just your personal federal tax return. So you'll have to make sure you're willing to present all that information. And again, it's the federal tax return. It's not a state return. They want to look at the federal tax return. You'll also have to provide bank statements, personal and business, and provide a history of how your cash flow is managed. Now, even if you've been in business, like SafeWork, for 25 years, every time we go and ask for an extension or an addition to our line of credit, I have to provide all this information, and even after 25 years, I have to provide my personal information as well. So this is a marathon, not a sprint. If you need to clean up your personal financial situation, do it now and keep it that way. It more than pays off as you stay in business. It's also important that you keep your business finances organized. You will have to provide financial statements, interim financials. Banks and lenders will ask for these because they can measure performance of a company before the end of the tax year. It's especially important for you to keep up to date and to keep accurate financial records. So they're looking for year to date. So, for example, you've just started your business, you've been in business for 8 months, you're doing great, and you want to try and get a little bit of a loan. So you need to be able to provide year-to-date financial statements. And in case I didn't mention it before, one of the best friends your company can have is a good CPA. You don't have to hire one to work full-time for you, but you need to have a really good CPA on your side that can keep you on the straight and narrow in terms of financial statements. Excel spreadsheets don't go across very well unless they're kept in a financial statement methodology that banks recognize. What else do you need? Well, if you're trying to get initial funding and you haven't even started your business yet, it's important that you write a business plan, or at the minimum a strong executive summary of what you're going to do, why you're going to do it, what your strategy is, what your competition is, what your projections are, where you're going to find the business. There's any number of places where you can find a nice outline of how to write a business plan. And in fact, if you have signed up for counseling services with GCAP, one of the things that we do in that arena is help you write a business plan. Existing businesses can write a strategic plan. We can revise our existing business plan or our executive summary. And in fact, that's an exercise that I'm going through, which is to revise our business plan and beef it up a little bit as we go out and look for additional extension on our line of credit. Not extension, an addition to it. I need a bigger line of credit. And the reason you would need a line of credit is we all know that one of the problems we have, hopefully, in our great businesses that we've started is after we've gotten business and we have clients and we're billing our clients, that's all great. It's being paid in a timely manner so that we can make all the payments we have to make is what can hang us up sometimes. So it's important that you sell yourself to the lender. Now, conventional lenders are savings and loans and banks for the most part. They typically have a stricter lending criteria, and collateral and above average credit scores are required. But you need to go and talk to the small business expert in your bank. For example, I know Bank of America has a whole bunch of people that work in a location in Pasadena that all they do is talk to small businesses about setting up lines of credit and small business loans. So I know Bank of America has it. Wells Fargo also has small business experts. And you need to talk to them, not just a lender that's sitting in your bank. You need to speak with the small business expert. In fact, I'll tell you a funny story about the Bank of America small business experts. I know somebody that works over there, and he was telling me that he had a call from a guy one day who called up and said he wanted a $10 million loan. Well, that's amazing. And so my friend said, well, okay, that's a little bit more than what we lend a small business, but why do you want a $10 million loan? And the guy said, well, I know that the current president is going to be building a wall between Mexico and the United States, and it's a huge project, and I figure I can get part of that, so I need $10 million so I can set up my business so I can help build the wall. Well, needless to say, he didn't have a strategic business plan. He didn't have a strategy, didn't have an executive summary. He didn't even have an account at Bank of America. He just was figuring that Bank of America would give him $10 million to do this job. So he was a little naive. Needless to say, he didn't get the loan. So make sure you do know what you're selling. And if you're selling yourself, sell for all you're worth. You have to sell yourself and your business to the bank, to the lender. They have to believe the passion that you have for your business. And they also have to see that your business will succeed. So as I said, visit your local bank first. They have all kinds of financing products and services, and they have referral networks. If they can't help you, somebody else will. If you don't get what you need from your bank, go look at other banks. And I've told you, Bank of America, Citibank, Wells Fargo, any of these banks will have a small business expert. But again, above average credit scores required. Above average credit scores required. If not for the business, by you as well. So keep that in mind. There are alternative lenders, non-banking institutions. For-profit companies like venture capitalists provide advances to business based on future sales. There's non-profit community lenders, there's micro lenders, but be very, very careful what you're agreeing to. Make sure you know before you accept and sign a loan or credit agreement. Some alternative lenders have a whole lot more flexible lending criteria. Collateral may not be required, or credit scores may not matter as much as overall credit history. There are many not-for-profit institutions that lend limited dollar amounts to businesses operating within their region. I know for SafeWork, after we were in business for a few years, I desperately needed some money because we were busy, we had contracts, but payment coming in was late. One of the good things about working in the public sector, it's not if you get paid, it's more when you get paid. But we were lagging behind and I had to make payroll. It's important to make payroll. If you don't make payroll, people don't want to work in your company. If you don't make payroll, you can't pay yourself. And I desperately needed $100,000. And I had been an American Express card holder for a number of years. And American Express, I called their small business number and they asked me how much I needed, and I said I needed $100,000. And the person on the line said, let us do a check of your personal credit. We'll let you know in 24 hours. I said, great. And in 24 hours, I had an agreement that I signed, and they loaned me $100,000 based on absolutely no collateral except my own good credit. And I paid it back on a regular basis. So it is possible to get these unsecured lines of credit, but you have to look for them. This is work. Again, for these non-traditional lenders, you can have more documents that you have to provide. The turnaround time on loans could be longer. For me, for American Express, it was shorter. American Express still has a very, very active small business program. You have to show that you have good business sense, and with the infusion of loans and grants, you will remain at break even and become successful. The underlining statement here is borrowers must be thoroughly organized and prepared. So, how are loan applicants evaluated? And these are the questions you can ask yourself before you go in and ask for money. Capacity, and that means, are you able to repay the loan? How? Capital, what are you worth? If you're a service company like we are, I don't have assets. I don't have things that I own. But I do have personal assets, which are pledged for the company. Conditions, what external factors impact your business? What will help you get more work? What will hurt you? And your character, how are you going to repay the loan? Remember, anybody that's loaning you money, whether it's a bank or your brother-in-law, wants to know not how are you going to do in the future, but when are you going to repay them? That's the important question that they want to know. Working capital is equal to current assets. Net working capital equals current assets less current liabilities. The liquidity of current assets affects the terms and availability sometimes of short-term credit. And the most liquid assets are cash, money market funds, and accounts receivable. I always laugh and say, gee, Citibank, you're willing to loan me, give me $1 million line of credit as long as I can show you I have $1 million of liquid assets in the company. Well, if I have $1 million worth of liquid assets in the company, I don't need the $1 million line of credit, do I? But that's kind of the game. You have to show that you have money, that you have assets, and that you can make money. And you have to show them in a compelling way. Do you have any judgments against your company that goes against you? Do you have your own investment in the business? That's a very important question. If a bank sees that you've got an investment in your own business, also known as skin in the game, they look at you a little more favorably. Do you have direct or related experience in the industry of the business you plan to launch or that you're in? Well, hopefully you have experience in the industry that you, or the business that you're in. This is the criteria that's most true for startup businesses. Most alternative lenders will require some kind of industry experience. Now, I've been in construction management for 25 years. If I went to find a loan to open a beauty shop or a spa, I probably wouldn't get the money. But if I decided I wanted to open up another construction management firm, I could probably get the money because I've been in the industry that long. And I have the assets and the success story to prove it. But I'm not crazy enough to go start up another business. The one that I have right now is more than enough. Also, you need to be able to talk about how you're going to use the loan proceeds. How will the loan money be spent? You need to be able to talk about startup or expansion costs and be able to present them compellingly and determine the amount you are able to contribute and how much will be financed. If you show that you're willing to share the risk, it's better. Short-term creditors are ultimately concerned with your ability to pay your bill as they become due. And they want to make sure that your business is liquid enough. Can you pay your short-term debt? That's debt that is owed within 1 year. It doesn't mean you won't get money, but poor liquidity may lead to a higher cost of financing. Why? Because the risk is greater. So consider that. Some credit card companies require the companies be in business for 1 to 2 years before you can get a credit card. But you may be able to get one earlier than that. Again, meet with a bank manager who specializes in small business credit cards and explain that you've been working to improve your business credit rating and you'd like to apply for a business credit card. Now, credit cards are good. Personally, they're good, and professionally, they're good. Only as long as you can pay back what you've essentially borrowed on that credit card. There's no faster way to ruin your credit than to miss a credit card payment. Most credit card companies will require your Social Security number to establish a business card. You may be able to provide your employer identification number, that is your IRS business Social Security number, instead when applying for a business credit card. If you have a good business credit history and the bank is friendly to small business, you can probably get a credit card under your business ID number as opposed to your personal Social Security number. But you may have to put your own Social Security number down to get the credit card. That means that credit card is tied to you personally as well. So be careful. One of the advantages of having a business credit card is that it's not negatively affected by adding more credit accounts. So you can have one card and then you can get another card and it won't negatively affect your credit. And your Paydex score, which is your business's credit score, is not lowered when anybody checks your business credit history, as it is when people check your personal credit history. So I am not recommending that you have 20 credit cards under your business. I am not recommending that. But you can have 1 or 2 credit cards. I am very financially conservative. I think that having 2 cards is good, at the most 3. You can also have a credit relationship with a vendor. so that they bill you. For example, Federal Express can bill you. Or if you have water delivered to your physical office building, they will bill you. If you're leasing office space, you have credit with them. Those are all good credit history representatives. So personally, I know that financial advisors suggest people have 2 credit cards. One is American Express and the other one is Visa or MasterCard, or some variation of that. Not everybody accepts American Express, not everybody accepts Visa and MasterCard, so by having 2 or 2 similar to those, you pretty much have it covered. On some credit cards, you're able to pull money out as well. So again, using a credit card is just like using a personal credit card. You have to have good credit history. You have to make sure you've paid off your bills. In fact, your credit record is established and solid when you have 5 trade accounts. That means 5 accounts of, let's say, a lease, purchasing of vehicles or leasing of vehicles, or buying of computers on credit, like from Dell or something like that, or cell phone credit or something like that. And here we're saying at least 3 credit cards. So there you go, 3 credit cards, and you have 2 small loans that you've paid off. Then you have really solid credit. You've shown that you mean to repay what you owe. You've shown good character. You've shown good credit worthiness. So when you choose a credit card, what should you look at? If you find one that has a 0% interest rate, introductory, that makes entertaining clients, scheduling travel, and buying office supplies easier. It's always good if you can get reward points. Look at the annual fees. But also look at if you get a fixed 0% introductory rate, make sure you look at what the rate is after the introductory rate is done. Once you start using a credit card regularly and you pay for your purchases, all of a sudden you'll see that your limits on your credit will be increased. If your company has been around for a couple of years, you may more easily apply for a major business credit card. This again is another way to develop the habits you need to be able to go with a good company business credit rating and get more money to grow your business. So when you go for a business loan, you want a loan amount. It's usually $25,000 and up. You will be charged interest, which is the prime rate, and a magic number that's based on the credit risk that the bank will come up with. Repayment terms are usually 90 days or longer. You will probably have to pay a loan fee of some amount, and believe me, you will guarantee it. And you have to have a legitimate business purpose in order to secure the loan, and be in business for at least 2 years. That is pretty much the way it is. However, talk to your bank. But I will say this, if you are the business owner, no matter how your businesses are structured, you will have to guarantee the loan, even if you have a corporation. I've been in business for 25 years. I still guarantee loans for the company. We're still a small business. We're still a disadvantaged business because I guarantee the loans that we have, the lines of credit that we have personally. I guarantee them. So if you think you're not going to have to do that, think again. You will have to put some skin in the game. Now, if you're here representing the company and the owners aren't here, you can go back and share that happy news with them. But you know what? That's why you started a small business, because you bet on yourself and you work hard if you have skin in the game. You work hard anyway, and you work really hard if you have skin in the game, but that's why you did this. That's why you're not working for somebody else right now. That's why you're working for yourself. A secured loan is secured by personal or business assets, like inventory, accounts receivable, or personal assets like your house. Unsecured loans really require excellent business and personal credit ratings, and they have a whole lot higher interest rate than secured type loans. Now, I told you the story of American Express, but I didn't tell you the interest rate that I had to pay for that unsecured line of credit. Installment loans are kind of good because they're a fixed monthly payment of principal and interest that you make, and they're sometimes easier to handle. I see here on the PowerPoint it says sample bank loan request. I don't have a handout. We can get it to you. But if you go to the bank, they will show you what the loan request looks like. Each one is different. And we've talked about everything you're going to have to talk about when you go to the bank, or you go to a credit union, or you go to a savings and loan. When you can't get credit from a bank, you may want to go to a commercial finance company. They will charge a higher rate, and they require collateral. The value of the collateral is greater than the balance of the loan and may consist of accounts receivable, inventories, and even fixed assets. These commercial finance companies will also finance the installment purchase of industrial equipment. This is good for contractors, especially if you build things and you own equipment. The equipment itself can be used as collateral. You can also put up your accounts receivable. So, for example, if you've done work but you haven't been paid yet, you can put that up as collateral. If you're selling stuff, your inventory can be a collateral. Collateral is anything that you have that is of monetary value. Sadly, your children and your pets are not of monetary value, neither is your spouse. So you won't be able to put them up for collateral, even though you may want to. That is a joke. I'm not recommending that anybody put their children or their spouse up as collateral for a loan. Line of credit. This is a good thing to have when you can get it. It's a line of credit. It means the bank will lend you money up to a specified amount on a recurring basis. They will charge you a fee on the amount of unused credit, possibly. Credit lines are established for a one-year period and may be renewed annually. And here's the secret with a line of credit. Lines of credit are not term loans. They are not a loan. They are money that you can draw out and pay back as you need it throughout a year. The secret here is to make sure that you pay off that line of credit at some point during that year for at least a 3 to 5 day period. If not, whoever is providing you that line of credit can take the amount that you haven't paid off through the year and turn it into a term loan, which reduces the amount of money that you can take off of that line. For example, say Fork has a $1 million line of credit. Now, do I walk in the first day and take the $1 million and put it in my account? No, I don't. What I do is use that line of credit to cover payroll for those times when the agencies and my prime consultant companies that I work for are slow in paying for whatever reason. Let me give you an example. We're working on California high-speed rail, segments 1 through 4. The first segment, we had 3 people on that project working on the construction management side of the house under our prime consultant. We had to go 6 months without being paid as they tried to figure out how pay would be received. Here's how it worked. We submitted our invoice to our prime. Our prime had to then scrub the invoices, make sure they were accurate, and submit it to high-speed rail. High-speed rail had to review them and then send them to the FTA in Washington, D.C. The FTA had to review the invoices, make sure they were correct, and then issue payment back to the state of California, who then had to issue payment to high-speed rail, who then had to issue payment to the prime, and finally the subs got their money. So I had to carry 3 people on that project making payroll, along with everybody else in the company, for 6 months. And there were times that I needed to go into the line of credit and borrow enough to cover payroll because I had to wait to get paid from high-speed rail, as well as some of the other projects that we were on that were also getting started, and it was difficult to get paid in a timely manner. Again, it's not if you get paid, it's when. Contractors have a different arrangement. There is a regulation that requires them to be paid more quickly, but those of us in professional services, most of the time we sign contracts that we agree to be paid when our prime consultant firm is paid, or if we have a prime contract, the agency may have a significant bureaucracy which can delay payment to us. At any rate, this is a very long story to say, so we borrowed money to make payroll, but as soon as we got paid, we paid it back. We paid it off. You pay it off and you borrow it. You pay it off and you borrow it. It's liquid for you. But don't hold an amount that you never pay off on your line of credit. That will turn into a standard business loan. Pay off your line of credit if you can. You can, again, they can charge, banks can charge a commitment fee on the amount of unused credit line. We paid an upfront fee. If the line of credit is adequate for your present and immediate future needs by considering the current and expected cash requirements of the business. It's really easy to say, sometimes it's hard to do. But someone once asked me what it took to start a small business, and I said, a stomach of steel and a very good relationship with your bank. And that was 15 years ago, and I would still say that today. It still takes guts of steel and a very good relationship with your bank. So in addition to everything else that you're doing, my dear small business friends out there, you get to develop yet one more relationship, and that's with your bank or lending institution. And this is exactly why the line of credit was good for us. The company was working on large projects for a long time, and we would obtain minimal or no payments until the job was complete. In our case, it was because the bureaucracy of various public projects is so dense that it takes a while to get paid. The disadvantages of lines of credit relate to the collateral requirements and the information that has to be presented to the bank. And believe me, I presented my entire financial underwear drawer for the company and for me. It's immediate access to funds, though, during tight money market conditions, and it enables safe work. And in this case, if I can personalize this, we only borrow as much as we need, and we repay it immediately when cash is available. The bank may also place other restrictions on a company getting a line of credit, a ceiling on capital expenditures, or requiring a minimum level of working capital. And when a company borrows under a line of credit, it may be required to maintain a balance with the bank. So in this case, the bank where we have our line of credit is also where we have our business banking accounts. Lines of credit provide seasonal working capital, can help you to purchase inventory, finance receivables, take advantage of sales, trade discounts, manage cash flows. To me, a line of credit is perfect for the kind of work that SafeWork does. I don't know if it would be perfect for the lines of work that all of you do, but it is something for you to consider. I've talked about the SBA. Here in the greater Los Angeles area, they have an office in Pasadena. They are there to help. The SBA has improved over the years. They do have a program of guaranteed loans that can help us that may not be otherwise able to qualify for credit. So I suggest all of you to, at some point in time, go over and visit with the folks in Pasadena, talk about how they can help you. And as I said before, if you're not getting the results that you want, go back and keep bugging them. That's what they're there for. They are there to help us. Sometimes qualifying for an SBA loan is easier than qualifying for just a straight up bank loan. You may be able to borrow up to 100% of what you need. They can help you purchase or renovate real estate. They can help you buy stuff. In general, they can help you. And again, that's why they're there. So be very assertive about going over there and asking for help. They also have a microloan program. Maybe you don't need a whole lot of money. Maybe you just need a little bit. Again, SBA loans are primarily for businesses that are owner-operated, for-profit, organized as a sole proprietorship, corporation, or professional partnership. And you have to be within the size guidelines designated by the SBA. And having a tough time securing credit under other reasonable terms. But in general, if you go over there, they will help you, they will talk to you, they will give you options. Now this is new. Patriot loans available for amounts up to $350,000 as a line of credit or term loan. Give you access to working capital, fund equipment. Loans more than $100,000 are secured by business or personal assets. Fixed or variable rates do not exceed 6.5% over prime. That is prime, the prime rate, plus 6.5%. You can get up to a 7-year loan. And there's other options that you can figure out with them, but they're personalized. Make sure you discuss your loan package with your bank representative to ensure it's complete before you submit it. You do not want it rejected. You want it submitted and considered. According to the Federal Reserve Bank of New York Small Business Borrowers Poll, 63% of those of us that asked for money in 2011 were able to get at least part of the credit. So what good is a letter of credit? Well, if you're buying and selling around the world, a letter of credit from a commercial bank guarantees that you will be able to pay on time and for the correct amount. A letter of credit, the bank is guaranteeing you. Sample letter, we will have that posted on the website. And I will ask that that be sent to everyone that's attending this webinar so you can see what a sample letter of credit is. Business leases. A lot of us have business leases. In other words, the company leases property that is owned by somebody else who may be the manufacturer of the asset or a leasing company. For safe work, we lease our vehicles that we provide for projects. For people that are working on projects. We lease our vehicle. So I have an operating lease with Ford. There is a cancellation clause, all that kind of stuff. And the life of the contract, the life of the lease, is less than the economic life of the property. And we always have an option at the end of the lease to buy the vehicle out. Now you may say, well, Rebecca, why don't you just buy the vehicle? Because I don't want to own vehicles. I don't want to have the responsibility of maintenance of the vehicles. I'd much rather lease them. For our projects normally last 3 to 5 years. I'd much rather lease them and hand them back at the end. Less headache for me. We don't have a liability on the books for me for the entire lease, only for the amount of vehicles that we've leased. A capital lease is different. Capital lease is when you're leasing capital equipment and the present value of future rental payments equals the purchase price of the equipment lease. Essentially, you're buying the piece of equipment over the period of time. At the end of the capital lease, you essentially own the property. True tax lease, this is something that I am not that familiar with, but you can get 100% financing for new and used equipment, plus low monthly payments terms, and you can postpone your decision to purchase the equipment until the end of the lease. I think sometimes these are true for like copying machines and other large pieces of equipment that you may need for your specialty services or work that you provide. This one, track leases, are for new and used commercial trucks, tractors, vans, and trailers. You borrow the entire purchase price, and you get lower monthly payments and a guaranteed purchase option at the end of the term. Another term, track lease, terminated rental adjustment clause. So why would you lease? Well, you don't have to put out a whole bunch of cash. You can finance up to the entire purchase price. It requires little or no down payment, so you keep more of your money while using their money to operate the equipment that you need for your business. Business leasing usually have low monthly payments. You have end-of-term purchase options that can have you determining whether or not you want to buy whatever it is you've leased. It's also a way to meet temporary equipment needs and provides flexibility in operation. Let's say I've got 10 people on a project for 3 years. I need 10 vehicles, but at the end of that 3 years, I don't want to buy out 10 vehicles and have 10 vehicles unless I've got additional work where I can use those vehicles. But I don't know that yet. So it provides me with a way to meet my temporary equipment needs. There usually is a purchase option at the end of a lease, so you can obtain the property at a bargain price. Again, it gives you some flexibility, and that's what this is all about. How can you use your money to your best advantage to grow your business? You want to make sure you understand what the lease is, and the leaseor is an expert at figuring it out. There are services available. When we lease from Ford, it also comes with maintenance. I don't have to worry about it. Leasing typically imposes fewer financial restrictions. It was pretty easy to get lease agreements with Ford, with Enterprise, rental vehicles. Your obligation for future rental payment need not be reported on your balance sheet if it's considered an operating lease. Capital leases have to be stated in your financial statement. That capital lease is when you borrow 100% of the purchase price. It is in essence a loan. Leasing also eliminates the need to figure out how you're going to dispose of the equipment. And leases may be available as a line of credit. Now, there are disadvantages in leasing. Higher costs in the long run than purchasing the asset. The leasee, we don't build equity. The interest cost of leasing is typically higher than the interest cost on debt. If the property reverts to the leaseor at the end of the lease, you either sign a new lease or you buy the property out at a higher current price. Any salvage value of the property is realized by the leaseor. And if you lease a vehicle, you can't make improvements to the leased property without the permission of the leaseor. This was an issue for us when we were providing vehicles for inspectors that are working on Caltrans projects, because they required a hard hazard light rack on top of the vehicle. So we had to have an agreement with Ford that we could put those on. There is such a thing called account receivable financing. This is also called factoring. It's using your receivables for financing. So let's say you have, for purposes of this discussion, $100,000 in receivables. That's money that you will be paid. You have sales of more than $250,000, let's say. And you are financially strong, you can get a loan based on what is owed you. So what this means is you're owed $100,000. You need some money. You can essentially use your receivables for financing if you are financially strong. There are institutions that will lend you money based on it. Now, again, called factoring. Factoring of accounts receivable means you sell your accounts receivable to the bank. without recourse. They are gone. The finance company, the bank, assumes all credit and collection risks. Remissions by customers, that means payment by your customers, are made directly to the bank, and the bank will charge you for the honor of holding your receivables. There is a slight advantage to factoring. It offers immediate cash, reduces overhead because the credit management process is performed by the bank, and it sure makes your balance sheet stronger. However, factoring, selling your receivables, costs you, and it will also possibly leave your customers with the impression that you don't know how to run your business because they are now paying the bank. My own personal opinion, do not sell your accounts receivable unless you are desperate. Okay, so you've heard the advantages of factoring, which is selling your accounts receivable, and the disadvantages. My own personal opinion, you don't do this unless you have no other recourse. Now, you can assign receivables, and that means you pledge you don't transfer the ownership of the accounts. You use the receivables as collateral, and the finance company lends you money based on those, but you still own the receivables. Slightly different than factoring, slightly better than factoring. They would usually advance between 50 and 85% of the face value of the receivables in cash. You pay a service charge and interest on the amounts advanced and any resulting bad debt losses, and you continue to collect your customer payments. But again, this is a little scary. You're paying a service charge and an interest on the amounts advanced. Can you ever move out of this? It can be a slippery slope. The assignment of accounts receivable has the advantage of providing you with immediate money, which is what we all want, making advances available on a seasonal basis, and avoiding that negative impression that customers may have if they're paying for your services to a bank. There is a cost to this. You still have to manage the collection process, and you still bear all the credit risk. So be careful. Be careful. You can also use inventory for financing. When you've completely used your borrowing capacity on your receivables and you have marketable, non-perishable, and standardized goods that have a quick turnover and are not subject to rapid obsolescence. So that means if you have a whole bunch of fax machines, those probably aren't going to be any good for using as a finance tool for you. You see what I'm saying? You have to have inventory. This is not equipment that you have. This is stuff you sell, whether it's computer equipment or construction equipment or tires or whatever. They are standard goods. They have a quick turnover, and they won't go out of use quickly. You can get about 75% of the value of those materials and finished goods. But once you do that, you pay a high interest rate and you have restrictions placed on your inventory. It doesn't belong to you so much anymore. So you can see in our discussion today, there's all different kinds of ways to find money. I would recommend that you start by having a good relationship with your bank and go and talk to them. Go and talk to them and ask for their help. Go and talk to them and ask how they can help you. Go to the SBA. We have a lot of resources available to us as small businesses. None of it is easy. You will have people that are rude to you. I have. You will have people that tell you no constantly. I have. But if you persevere, you will succeed. All of us took a risk when we started our own business. Congratulations to us all. Don't ever forget how brave you were to do this, and don't ever give up.